This is week 18 of investing every week in the stock market. I started this series to document my journey in the stock market and in the hopes other people might get motivated to start investing or stay consistent with their investment journey. If you're interested, do not forget to subscribe. Every subscriber matters and helps get this video to the right people. This week we have around $750 to invest, plus some other money left in my other accounts through dividends that I received, for a grand total of around $775 or $780. My first buy, as always, is going to be in the S&P 500. In my opinion, the holy grail for ETF investing for any individual retail investor like myself. The S&P 500 is an index that tracks the 500 biggest companies in the United States of America. Banks, financials, tech, healthcare, consumer goods, literally anything that you can think of is included in the S&P 500. Historically, this index has returned 10% on average for the last 40 years, and for the last year, as you can see, it has returned 24.5%. If you look at the 5-year chart, it's even better at around 109%. I'm not saying the S&P 500 can give these returns of 20% per year. What I am saying though is that if you do believe in the US economy, you do believe in US capitalism, for the good or the bad that it brings, you might want to take a look at the S&P 500. For a younger investor like myself who does not plan on seeing this money for the next 20 or 30 years, I think the S&P 500 is an excellent bet for that 10% per year average. For that reason, I'm going to buy one share of the S&P 500, to the order, and done. My next buy is going to be the NASDAQ 100 through this ETF HXQ, a global X product. Much like the S&P 500, the NASDAQ 100 is an index that tracks the 100 biggest companies in the United States of America. The only caveat with this ETF is that it's extremely tech-focused. Apple, Nvidia, Microsoft, Google, Tesla, literally every single tech company has done tremendously well over the last 5 years since they have delivered the most value. If you don't think tech is the future, you might want to stay away from this ETF. But in my opinion, tech is the now, has been the past, and is going to continue to be the future. Because every forward-looking industry is technologically focused. AI, automation, robotics, anything that's going to improve humankind's productivity is directly linked to technology. It's been up 25% for the 1-year chart. The 5-year chart is absolutely mad at 165%. Once again, not sustainable for the future, but if you do believe in technology, you don't have to look anywhere else except the NASDAQ 100. And for that reason, I'm going to buy one share of the NASDAQ 100, to the order, and done. My next buy is going to be in a leverage S&P 500 ETF through this ETF USSL. We know what the S&P 500 is. What does leverage mean? Leverage essentially adds on to your returns. This ETF is 25% leverage, which basically means if the S&P 500 goes up 10%, this ETF is going to go up 12.5% minus leverage costs, or the cost of interest the ETF provider has to pay for taking out a loan to buy more of the stock. The opposite is also true though. If the index goes down 10%, this ETF is going to go down 12.5% plus leverage costs. You can see the pros and cons here, but the underlying thesis remains the same. I expect the S&P 500 to have a positive return in the future, and not just a positive return, but a really positive return. Leverage adds on to that. I might not see the benefit for this in the short term where the S&P 500 goes down and this ETF goes down even more than that, but I think the 10, 20, 30 year advantage of me holding leverage is tremendous. So I'm going to go ahead and buy 2 shares of USSL, to the order, and done. My next buy is going to be in a leveraged NASDAQ 100 ETF through this ETF QQQL. Much like the leveraged version of the S&P 500, the leveraged version of the NASDAQ 100 is going to add on 25% to our returns. Let's say the NASDAQ 100 goes up 10% next year, this ETF is going to go up 12.5%. The underlying thesis is the same. Do I expect the NASDAQ 100 to have positive returns in the future? Yes. Do I think leverage, modest leverage at 25% will add on to those returns? Yes. In the short run, this might not pay off and I might see a large drawdown, but I think you have to look at it from a 20 or 30 year perspective, especially if you're a younger investor in your 30s or 40s. I think leverage is an instrument that can massively add to your portfolio. And for that reason, I'm going to buy 2 shares of QQQL, to the order, and done. My next buy is going to be in Google. Google is a company that needs no introduction. We use all of their products literally, from search, Google Maps, Gmail, Calendar. They have a whole suite of products that consumers like you and I rely on. And not just consumers, even businesses rely massively on their Google Cloud division that has done extremely well in the last few years, growing at an exponential rate. Google has taken a beating in the previous month, being down 13%. The 3-month chart is good though at 1%, and the 1-year chart is also excellent at 25%, but I think Google is at a valuation that I just simply cannot ignore it at. If you look at the PE ratio, its PE ratio is 21. Compared with Microsoft and Nvidia and Apple, It's just tremendous. It's just mind-boggling that Google is at such a low valuation when I think personally that it has probably the most potential, if not the most potential, for any of these companies. It owns its own products when it comes to search, social media, the Google Cloud division, and is rapidly expanding in developing markets, also taking the lead on AI and AI research with their new Gemini products. Not to mention their recent investment in quantum computing that did see a massive breakthrough. I think Google has a massive amount of data, if actually not the most amount of data of any big tech company, and it can harvest that data to take a lead in AI, in quantum computing, and other technologically focused industries. A PE ratio of 21 does not make sense when the revenue growth rate is good in the double digits, the profit margin is solid at around 30% and constantly growing as well. The operating income it has is more than some countries' GDPs. I just simply cannot ignore Google at this valuation, and for that reason I'm going to buy one share of Google, queue the order, and done. My next buy is going to be in the Canadian market, home of Maple, not home of the handsome Prime Minister anymore, unfortunately. But I do like investing in the Canadian economy since I do live in Canada and I want my surroundings to flourish and I want everybody to be extremely, extremely rich. Nevertheless, VDY tracks the FTSE High Yield Dividend Paying Index. It includes companies that are in the financial sector, the telecom sector, the energy sector, all the oligopolies that we love and adore in Canada. It has done well for the 1-year chart, up around 17%, but the real kicker is that the dividend yield is nice and juicy at 4.2 to 4.5%, depending on the price of the stock. So I'm getting this 16.8% return plus the dividend yield for a grand total return of 20 point something percent. Not bad for a Canadian index. I think Canada as a country has tremendous potential and opportunity in the future, specifically with the natural resources that it has. It has lagged the US in the last few years, but given how strong the industries are, the oligopolies that I mentioned again and again, I can only see them expanding and increasing their influence on Canadian society, as sad as it seems. But for me, as an investor, I want to take part in that, and that's why I'm going to buy 2 shares of BDY, to the order, and done. Long live Canada. My next buy is going to be in HYLD. This is a Hamilton ETFs product that is a covered call ETF tracking the US market. The US market we've sort of covered before. What does covered call mean? Covered calls are an option strategy that increase your income now but sacrifice the long-term performance of your portfolio. In online circles, people really fight each other a lot, defending one side or the other. But for me, covered call ETFs are a way to stay interested in the stock market since I see my monthly income go up every single month. For example, the S&P 500 has a yield of 1%. This ETF, HYLD, has a yield of 12%, meaning I'm 12xing my yield. Of course, the performance is not the same. As you can see in the last year, HYLD is only up 5.42%, even with that 12% yield. It is underperforming the S&P 500, but I don't invest a lot of money in covered call ETFs. Like you can see, I'm only buying $27 worth of HYLD. For me, the motivating factor of pumping money in the stock market every single week for this series and for the benefit of my future self far outweighs the underperformance of this 10%-ish of my portfolio. Most of my portfolio is still in growth first ETFs and growth first stocks. As long as I have a nice portfolio performance and a nice yield, I'm happy. I'm a happy camper. I'm a happy guy. I'm a happy buckaroony. 2 shares of HYLD, to the order. My next buy is going to be in QQCL. This is a covered call ETF tracking the Nasdaq 100. The investment philosophy is extremely similar to HYLD. I want to see income now. I want to see my monthly income go up. QQCL has a nice monthly income of around 13.5%, and the price appreciation is not bad, around 14.27% in the last year, plus that 14% yield for a grand total return of nearly 27%. Once again, not a lot of money. I'm going to buy only 1 share of QQCL since I don't want to invest a lot of money in covered call ETFs. I want a large percentage of my portfolio to be growth focused. But I just cannot ignore how much motivation I get from seeing monthly dividends and just seeing my yearly dividend amount go up. So I'm going to buy 1 share of QQCL, to the order, and done. We have no money remaining. That means this is it for this week's video. Do not forget to smash the like button and the subscribe button if you enjoyed this video. Every like matters since it helps get this video to the right people also interested in money, finance, and how to invest better. I'll see you next week.